SoFi is showing unusual activity today, and many investors are trying to understand the reason behind the sudden move. Let's examine the facts. Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell. But before that, this is not a financial advice video. SoFi is experiencing a sharp move with the stock sliding more than 6% during today's session. The trading range has been fairly wide, with the day's low landing near $26.93 and the high touching approximately $27.93. Trading volume has exploded past 91 million shares, signaling unusually heavy participation and a high level of attention on this ticker. The main spark behind today's volatility came from an after-hours filing where SoFi submitted an S3 shelf registration. This filing effectively authorizes the company to offer shares over the next 3 years at an initial reference price in the $27.50 range. The filing mentions roughly 54 million shares with an optional 30-day extension of about 8.1 million additional shares, bringing the total potential raise to around $1.5 billion. If someone calculates basic dilution based on the company's prior market cap, the impact should be around 4 to 5%. But the market's reaction has been harsher, which shows one thing: traders don't like uncertainty around dilution, even when the numbers aren't extreme. The opinion across social platforms is split. On places like StockTwits, SoFi is the most discussed stock of the day. On X, Twitter, and other communities, the debate is intense. Bearish voices argue that this is the second major issuance within 6 months, and they believe it signals a trend of constant dilution. Bullish investors point out that SoFi already had strong liquidity according to the previous earnings report, which makes the issuance look strategic rather than desperate. Looking at SoFi's past behavior, the company has used similar shelf offerings before, especially in 2023. At that time, they did not require emergency funds. Instead, they built financial protection in case economic conditions tightened. So it's possible that this new filing simply reflects the same cautious approach. The more speculative view is that SoFi is preparing for a potential acquisition in the digital asset or crypto space. This theory is circulating, but there is no direct confirmation. Many financial institutions gather capital in advance for optionality, not necessarily for immediate spending. SoFi has shown in previous years that they prefer maintaining a safety buffer. From a long-term investor perspective, dilution is never good news. But over a span of several years, events like this tend to fade. Most investors have already forgotten the 2023 issuance. The same will likely happen with this one unless the company repeatedly issues more shares, which is not currently the case. Meanwhile, macroeconomic conditions today are creating confusion. The PCE inflation report landed exactly as expected, and Michigan consumer sentiment was also flat. Mixed data often leads to indecision, and that's exactly what we saw this morning. Several analysts remarked that Thursday's rally was overdone or premature, especially with the Federal Reserve still sending unclear signals. Interest rate expectations remain critical. At the moment, markets are pricing an 87% probability of a 25 basis point cut. Some believe yesterday's momentum was the market trying to price in upcoming cuts too early. Comments from policymakers hinting at a December cut and possibly a January cut as well added more noise to the discussion rather than clarity. Another potential catalyst floating around today relates to geopolitical and trade developments. Reports surfaced that the U.S. administration may hold discussions with Canada and Mexico regarding trade adjustments. These meetings are not confirmed, but traders are watching closely. Any significant trade news could impact overall risk sentiment. Investors are also keeping an eye on whether SoFi will be added to the S&P 500 index. If that happens, historical patterns suggest a strong upward reaction, possibly around 10% due to institutional buying and passive fund inflows. This possibility is one of the reasons traders are hesitant to fully abandon their bullish thesis. Short seller data tells an interesting story today. Around 32,000 shares were returned by shorts, which often signals that the sell-off is being driven by emotion rather than fundamentals. If the bearish move were justified, shorts would likely add to their positions rather than unwind. The current short interest stands near 9.9% of the free float, totaling around 118 million shares. While that's not extremely high, it is enough to influence sentiment during volatile sessions. Options activity is also elevated, around $80 million in call volume versus $32 million in put volume. However, almost half of today's option trades were bearish and occurred in the first 30 minutes of trading. Early morning options activity is often driven by algorithms or knee-jerk reactions, so it does not always reflect the full-day sentiment. Price expectations show bulls eyeing a close above $28, while bears expect the stock to finish below $27. Expiration day pressures are influencing this battle. The options chain shows significant open interest at the 28, 28.50, 29, and 29.50 strikes, each holding thousands of contracts. If SoFi joins the S&P, these levels could trigger a gamma-driven move toward the 30s, but without confirmation, this remains speculative. Darkpool data reveals large institutional movements. One transaction alone was 24.9 million. Several others, 1.9 million, 1.3 million, 1.2 million, indicate steady dip buying from funds. Short sellers aren't the active force today, so these dark pool inflows are more likely coming from hedge funds positioning for long-term gains. The technical setup shows SoFi dropping below its 50-day moving average because of the dilution news. The price currently sits between the 50-day and 100-day averages, forming a temporary wedge. The reaction over the next few trading sessions will determine whether it reclaims the 50-day and continues upward or breaks below the 100-day and loses momentum. The stochastic RSI is extremely overbought, which adds to the downside pressure. Algorithmic trading appears heavily involved today as well, judging by the repeating microtransactions throughout the session. This automated activity often exaggerates moves following news events. At the moment, there are no fresh analyst ratings for today. The most recent came yesterday from JP Morgan and Mizuho, both giving a $31 target, one raising their target and one lowering it. This mixed outlook reflects the market's divided opinion. In summary, the dilution news has created short-term volatility, but the underlying institutional behavior suggests accumulation rather than abandonment. Macro data is confusing the market, options expiry is adding pressure, and upcoming catalysts, such as potential index inclusion and interest rate cuts, remain in focus. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.